Let us now look at the other method of valuing equity stocks using comparables. To understand comparables, let us begin with looking at this graph, which is a chart showing price earnings multiples of the 50 largest companies in India by market capital. Now, the parameters or the ratios that have been taken, they are not so important. What I would like you to see is the categorization that has been made using the sectors. And are you seeing any concentration or clustering or patterns within the dots of similar color? So you may see that all these blue dots are clustering somewhere here, which are the natural resources companies. Then you see that all these teal colored IT companies are in this range. None of them is above 50 and none of them is below maybe around 25. So all of them are, and if I exclude this one, then most of them are in this very narrow range. So if you start checking with a finer lens, you may observe some more patterns. Now, I found these two trends in the banking, financial services, and insurance sector. As the size increases, we see a declining trend in P by E ratio. And in the IT, as I said, it's a flat trend across, irrespective of the size, that is the x-axis. This is an information which tells me that these companies are similar in some ways. We know that most IT companies have a similar work culture, similar attrition rate, similar hiring practices, similar project management practices, and so on, similar clients quite often. And therefore, their profitability or their growth rates or their future prospects are very much similar, and therefore these companies enjoy a similar P by E ratio, which is in the range of 30. Whereas in the case of natural resources companies such as metals, minings, oil and gas, these companies have a much lower P by E ratio. So barring these some exceptions here and here, most of the other companies are in this range, which is let's say less than 20 P by E ratio or P by E multiple. Now this tells me that the natural resources companies have uh, limited scope for growth as compared to the IT companies, which are having a much higher P by E ratio. Now, what are we trying to achieve through this is we first try to find out some comparables, and these comparables will be uh, companies which look similar to a company that I am trying to value. So if I am trying to value an IT company, then my comparable will be an IT company. If I am trying to value, let us say, a tire manufacturing company, then my comparables will be tire manufacturing company. A cement company will have a comparable of another cement company. Although they may not always be from the same sector, sometimes we may look outside the uh, sector as well. Now, what are the different steps to be taken? I have given a Moodle exercise which should be solved along with this. But these are the broad steps. We pick the company which is to be valued, about which we do not know. We obtain its financial statements, and then find out which are the other companies about whose value is known and we trust that valuation. So these comparable, similarly sized, similar industry sector, we collect its valuation as well as the financial statements. So then we, in step number 3, we calculate the multiple. Typically it is the P by E ratio, but there could be others as well. The multiple is then calculated for all the comparable companies. There may be one or more. Then we arrive at the industry average ratio and use that ratio with the financial statements of our target company, whose value we do not know. And then we make use of both these to find out the price. Let's try to understand this with an example. let's say there is a fictitious large IT company, let's say an IBM or an Accenture or an IT arm of a bank, say a Credit Suisse or JP Morgan, which have their own IT arms, which are not listed companies, and we want to know their value. So first step will be to obtain the financial statements of this fictitious company. Step number 2 will be to identify the comparable companies. So we can say that large cap IT, big four IT firms can be your comparables. Then the price earnings ratio of all these four to be calculated, and I know from the available data that it is in the range of 26 to 37, and let's say that it is at an average of 31.5. So that's, we can say that the companies in IT industry, the large cap companies, are usually in the range of 31.5 P by E ratio. Some companies may do a little better because of some specific factors. Some may be doing a little worse because of some other specific factors, but on an average it stays at 31.5. Now I will just use this with the EPS of my target company, and I'll get the share price of the company. So the formula is very simple. I basically see that industry P by E equals the company P by E. So from company P by E, I move the earnings on this side, that is EPS, I get the price of the company. Now, price earnings is not the only multiple that gets used in these valuations. We can use any other factors. For example, you could use the earnings before interest, tax and depreciation. You could use revenue multiples. So the earlier one is called as the EBITDA multiples. You may hear that quite often in the analysis presented on news channels. You could use the employee count. If it's a bank, you could use number of banks, branch, or number of ATMs, or number of accounts. You could use capacity. Say if it's a power plant, then power generation companies, then we expect that the value of the company is proportional to its installed capacity of power generation. It could also depend on, say, for a mobile phone company, it could be based on the number of subscribers. It could be based on number of amount of data used or data sold. It could be based on the book value, so which is called as the book to market ratio. So all such ratios could be used for coming to a proper valuation, and that's how the valuation by comparison is done.